Joining me to discuss the main catalyst for this is Mike Mayo. He's the managing director and senior research analyst at Wells Fargo. Mike, before we get into your bullishness, I mean, isn't this year in some ways a repudiation of your thesis that technology is more important than interest rates? Because they just still seem to trade like rates are all that matters.
No, you're absolutely right. I mean, banks have been one of the worst performing groups this year. In terms of the technology theme, the industry has taken a detour. But I will say, since Pfizer Monday, since November 9th, when news of the vaccine first came out, banks have been some of the best performers, far outpacing the S&P 500. And we think this has only just begun in terms of outperformance.
We've seen that. We've seen the financials and energy and all of these trades kind of start to perk up a little bit and come to life. All right, so for investors who are thinking about dipping their toes in, what would you say are the supports that you visualize for 2021?
Well, I'll tell you, my eyes really were opened when I attended our own firm's technology conference last week. There were over 185 presenters, and it just showed the potential for technology to create the greatest restructuring in the history of modern banking. So let's look at technology past. Jeff Bezos says this quarter's results were baked 3 years ago. Well, this year's results for the technology leaders like Bank of America and JP Morgan were fully baked 3 years ago, because you've seen the greatest acceleration of the adoption of digital banking in history. Consumers that use digital banking have increased from 1/3 to 1/2 over the last 2 years. And for the leaders like Bank of America, it's 2/3. So you're seeing the fruits of prior investments and technology present. If you look at this year, this actually validates the technology theme. While the industry's taken a detour, it's been to support consumers, corporations, and the economy during these stressful times.
Right.
I mean, they started from scratch. They started up the small business lending programs known as PPP. They processed unemployment claims. They've done financing for customers. And they've done all this with over 90% of employees working from home. And then technology future, that's what I saw from the conference last week. These technology companies have already implemented solutions to other industries. Now it's simply a matter of getting to the banks. And I did bring a prop, Kelly, sometimes you like these, but banks still have a degree.
I knew you might.
Banks still have a large degree of Pac-Man era technology. Remember Pac-Man?
Yeah, I take your point. I don't even think you needed the prop to make that point. We all experience it. Mike, let me ask you this. I've been thinking a lot about the Cash App in the last couple of weeks, because it's all I ever hear about. People talk about how they can buy Bitcoin with it. There was an analyst upgrade the other day who talks about how you can now have a debit card and all of these different features. So, and I've had a pretty good experience with my big bank technology. But here's my point. Why, as an investor, am I not going to back Square and Cash App and Fintech? I mean, Fintech, yes, technology, banks have done a good job with it this year, but this has been a huge, huge year for Fintech. Why are they not going to be where the investment dollars are flowing and where I want to be for the next couple of years?
Well, look at Zelle. I mean, year over year, payments through Zelle are up 80%, and that blows away a lot of other fintech. So some of the best fintech players on the planet are at the largest banks, like Bank of America, like JP Morgan. And I just think it's embedded inside the bank, and it's not getting recognized like others. And first, you have to get the peace dividend for the bank. So we estimate bank earnings will benefit by over $100 billion from a peace dividend once the war on COVID is won. And so that's the cyclical play. But what I'm talking about here is the structural play that has legs, not just for the next year or two, but for the next 5 or 10 years. Yeah. So stage one is the cyclical recovery from COVID, and then stage two is this technology transformation, which has had a detour this year, but we think it's back on track post-COVID.
All right. Mike, I want to switch gears with you since you're here and just get your thoughts on these headlines that Goldman might move its asset management business to Florida. What do you think? Is that just a high-stakes negotiations to get a better rent deal in Manhattan? What's at stake if they do move down south or to Texas?
Well, once again, the success during the pandemic for the banking industry and for Goldman Sachs should give more confidence that they can work effectively with a workforce, throughout the country and throughout the world. Remember, Goldman Sachs at its peak had 98% of their employees working from home. Now, they've already used it for outsourcing or locating to lower cost environments like India and Poland and Salt Lake City. But it's not just for lower cost jobs anymore. Now we're talking about the higher paying jobs potentially getting moved to Florida. And look, I mean, it's all about saving costs, saving money. You do have headwinds in the banking industry. They're not going away. And that's why whether you use technology or real estate or other means, banks must become more efficient. And by the way, this news, it's not been confirmed by Goldman Sachs, but it would be consistent with their goal to save over $1 billion over 3 years through more effective real estate management.
Yeah. I can tell you, when you live in the tri-state area, every headline like that puts you on edge. Mike, thanks for your thoughts today, and the Pac-Man. We appreciate it.
Thanks for
Mike
having me.
Mayo on the banks.
Shepard Smith here. Thanks for watching CNBC on YouTube.